Credix. And yeah, before we dive in, welcome, my friend. Please, before we get started, how do I pronounce your name?
Thank you for the invite. My name is Shaim. I didn't
Shime.
choose myself.
I butchered that so bad. I knew I had to say something. Chime. And where are you calling in from?
Calling in from Rio de Janeiro in Brazil.
Rio de
Should be
Janeiro.
sunny here, but it's not today.
I always think of sun when I think of it, but I guess there are cloudy days. I have heard so many things about Brazil. I wonder what is crypto adoption like out there? Like, is it something that the average person it's in the vernacular, or is it still pretty uncommon?
It's actually one of the countries with the highest adoption in the crypto space.
Really? So what is that like?
Latin America in general is quite crypto savvy because obviously like Venezuela, Argentina, problems with inflation, so it's a way to get kind of
Yeah,
stability in your financing, I guess. But here in Brazil, the central bank is very progressive and innovative regarding everything real digital, CBDCs, crypto. So there are actually quite some progressive regulations here as well. And it's just a very, yeah, people tend to be very interested in crypto here. So a lot of people hold it, buy it, trade it. There are a lot of small startups working on crypto projects, specific crypto VCs. And actually, Rio de Janeiro has even kind of a crypto valley, they call it here.
the
And
crypto valley.
you can even pay your taxes in crypto here in Rio de Janeiro. I think the treasury of the city of Rio de
Damn,
Janeiro is putting 1% in Bitcoin. They announced last year, so it is quite
damn.
crypto
It's a
friendly.
1% city already. That's fantastic. I've been asleep on Latin America, so you'll have to fill me in on some of this because I just keep hearing the rumors. And just earlier today, there was a conversation kind of discussing what can we do to support people in different communities, and like where should we put our
Yeah.
focus. And yeah, Latin America kept coming up. I'm interested. I saw on your Twitter feed that you guys just opened up a fund for Latin America or something. I was wondering, could you kind of walk me through what kind of, I guess, kind of walk me through the perspective of what you're looking for in potential investments in this market climate? And then on top of that, why Latin America specifically? And yeah, what do you see there?
Yeah, let me start with the second part. So my background has always been into finance and into blockchain. So for the last 8 years, been building enterprise blockchain solutions for large stock exchanges, large banks, large custodians, and it's really bring that enterprise blockchain experience to the DeFi space that we're acting on today. And then one of the things we were always working on are real world use cases. So commercial papers, KYC, data sharing, like real stuff, less in the super Web3 fluffy NFT space. And looking at DeFi in 2020, we were doing like consulting for large banks in the United States. They were like, should we get into crypto? Should we not get into crypto? What about
Yeah,
DeFi? Where did the returns come from? And very fast, we saw that like it's not going to be sustainable, these returns hundreds of percents on DeFi yield, that's not gonna last. It
yeah,
needs to come from somewhere. And if it's not a tokens, where it's gonna come from? So that's where we made the link. We're like, let's connect it to real world where the returns will come from. And then a basic use case of DeFi is borrow and lending. And so that brings us actually to Latin America, where the cost of getting access to capital is one of the highest in the world. Like
yeah.
the average cost of loans here in Brazil are 83% a year. Credit
Wait. Are you saying 8 to 83 as in double digit?
83 as in double digits.
What in the? I'm
That's
sorry.
the
Like I
average.
thought I heard in the Philippines they have 14 to 20%, and I thought that was maddening. 83%. I'm sorry, man. I've literally never heard of that. Wow. How is
Yeah,
that
like
sustainable?
credit cards is up to it's higher than 300%. But all right, those are credit
What?
cards.
Three hundred
But those are
percent,
ridiculous numbers, right? Yeah.
dude.
And so the Latin
Wow.
American region is comprised of a lot of
What?
credit usage in general. Everyone buys everything on credit, like um, buy
So
now pay
even
later.
with the
Actually,
fees, people are still paying for stuff on credit. It doesn't discourage.
does not really. And buy now
Wow.
pay later actually exists for years and years already in Brazil. It just had another name. It was before everyone else. And
Yeah.
so it's something very cultural here. And so obviously access to credit is in that sense expensive. Banks get to choose to whom they are lending money to, because a lot of unbanked people as well, so they can, yeah, make sure that the cost of credit is high enough. And it's difficult for other investors globally to have access to this kind of markets here. Although kind of investment protection is quite good, securitization as a whole, bond issuance is quite sophisticated. It's
Yeah.
just difficult to access because it's other culture, overseas, bureaucratic, and so forth. And so what we
Wow.
were like, if we could connect that and connect that to a by itself global technology, being blockchain, Solana, what
Hmm.
have you, we actually have quite a significant role to play here, and there is a business case. And so that's how we, that in combination with back in the days, our team mainly coming from Belgium, with like paying money to put money on your bank accounts, at least last year, we're like, this makes sense if we could make those people invest in Latin America. And that's how the ball got rolling. I'm myself half Brazilian. I got into Brazil. I've been working with the fintechs here. What we're doing is providing access to investors globally on the institutional side. So we don't have any retail. So high net worth individuals, family offices, hedge funds, crypto funds, credit funds, they get to invest through our platform in USDC to those fintechs. And those credit fintechs here are kind of competing with the banks, and they provide loans to SMEs, agro sector, auto loans, student loans, and so forth. But yeah, those fintechs need access to capital, so we bring that to them in USDC, and they lend it in their local currency to their end clients. And so it's a very efficient way of investors to have access to these kind of yield opportunities, what is
Yeah.
yielding 12 to 20% on USDC, but it's backed by real assets, by real loans. So you have loans as collateral and so forth. So we can go much deeper into that.
I
So
would
that's
like to, because real quick then, touching on the loans are backed by real assets, and I'm guessing it sounds like there's much more strict KYC, AML, just overall regulatory and risk management procedures than, well, let's say FTX as an example. So one of the things I've always wanted to hear somebody explain, like I'm five, is of course we have accredited investors, institutions, family offices, and then we have retail, which is going to be anyone who doesn't have to fill out special paperwork in order to buy and sell stocks. I say that because what is the difference between what a platform like what you do, like what is it that the institutions are paying for or deciding to use in your platform that they wouldn't want from the platform that retail is using? Like what is that difference that you're providing that makes you optimized for institutions?
it doesn't really come from that angle because we would love to have retail at some point on our platform. It's more that just from a accreditation perspective, just from a regulatory perspective, investors that are not considered high net worths or don't or are not sophisticated, they should not be investing in this kind of credit products. That's
Hmm.
the idea that they're not ready for it and so forth. So it's more
So it's a
uh,
regulatory challenge then.
it's a regulatory SEC
That's
security
fascinating.
law, and that's actually preventing us to be able to open it up for non-accredited investors.
So how
So that's
much
the angle. It's
volume
not
do you
because we
think
don't
is
want it.
that difference? Just out of curiosity of if you have strictly institutional versus if you're able to open up to like all retail.
It is quite big, I think. So there's a big retail market, obviously. I think there are three steps. One is KYC or non-KYC, and if you do KYC, do you also need accreditation or not?
Hmm.
And accreditation means that you're going to prove that you're indeed a high net worth individual, family office, or so forth. That's the second step. So who knows? At some point, we're able to drop the accreditation requirements, but the KYC requirements we believe will always be necessary. So they know your customer, that we know who is interacting with our platform. Because different than other crypto, extreme DAO, decentralized platforms, in our case, we have regulatory requirements. We need to be able, at some point, if the central bank or the local SEC asks, like, where's the money coming from? We need to be able to say it comes from here and here and here, and these are the sources, and these are the AML checks that we did, and these are the KYC
Hmm.
profiles that we've done onboarded. And so that accreditation and that KYC happens today through Securitize. So Securitize does that as a third party offering of every time checking when you want to invest into Credix, you need to go through that. There's a simple digital onboarding flow on our application, app.credix.finance. You connect your wallet, you go to securitize, you need to leave some information. They're going to validate if you're really eligible to invest. If so, it's going to connect and we're going to link kind of a token to their wallet, which will whitelist their wallet to interact with our platform. And this way, we're able to track who can and cannot invest through
Yeah.
credit. Same from the borrower side. So the fintechs need to go to KYC to be able to get access to the capital on our platform. So we are really here using blockchain as an infrastructure layer to connect both parts of the world, rather and then the efficiency that it gets, the tokenization aspect and so forth, the waterfall we can talk much more about as well. But it's not really the super fluffy. Everyone can connect with everything at any point in time, and we don't
Yeah,
need to know
yeah.
everything.
The
So it's
decentralized
different in that
utopia.
sense.
It is still a system. It's just a different system.
Yeah.
I'd love to hear more about the tokenizing real assets concept, because there's a big conversation of like, well, what percentage of the general asset markets at large are going to be coming on chain at some point, whether that's just as a denomination towards crypto or the tokenizing through crypto. So I guess I wonder, what is your take based on what you're seeing in the current market conditions? Are you finding that there's still more demand in tokenizing assets, or have you seen a slowdown, or kind of what's the market been looking like from your side?
I think for real world asset applications like with Credix, we're seeing quite a big uptick because we're able to provide returns which are sustainable and come from real loans. So the end customer got a
Yeah,
loan for a car. Actually, who is paying us is not even the fintech, it's actually the car loans of the end customer. So that's going to maintain and keep going. It's not going to change. It's not. There's no correlation with crypto in that sense. And if you then look into the DeFi applications that exist that are providing USDC returns, man, those go down to 1-2% maybe, and even there, it's not even clear where those really come from. And if you, yeah, we're able to provide 6 to 10 times higher returns. Obviously, in our case, there is some credit risk in that
yeah,
sense, and we can speak about credit, how credit is structured, and so forth to minimize that risk. But there are also some other, if you look into smart contract risks and some other things that some other protocols have, compliance risk, regulatory risks, that's something that we have much less. We have also an off-chain legal recovery structure in case anything goes wrong and so forth. It's not possible if you were even able to hack. There's actually no money on the platform because it's borrowed out to end clients who are actually converting to local currency.
yeah.
So the platform is really different. So we're seeing quite a big uptick in real world application, not only volume, but also in use cases. We're seeing more and more um, other companies, other teams also getting into the weeds of real world applications. We see banks working on tokenizing bonds more and more.
Really?
We see a lot of
Nice.
interest in this space because it's we believe the future, or really the what can and might be empowering the next bull run in the blockchain and crypto adoption space is actually real world application, real world use cases, and of this, the financial capital markets aspect is quite big.
I mean, so at the rate that you're seeing, because I guess I'm thinking about a year and a half ago, I saw an interview. I wish I could remember who it was, but basically describing how many people, how many bankers, how many people on Wall Street, how many people like in the institutional sector actually take crypto serious, like are actually looking at implementing this somewhere. And at the time, it was the vast minority. I mean, just really barely a consideration. So I wonder, have you seen it to where now adoption is more like we're past the awareness phase and now it's more like the consideration of how to apply, when to apply, or kind of what stage of that cycle do you think that institutions are at when they're thinking about how to interact with crypto?
Yeah, I kind of hate to break it, but I think there are less bankers that trust crypto now than they did last year in that
Brutal.
sense. But I think there are much more bankers that understand blockchain stable coins, real USDC coins, and central bank digital currencies than 1 year ago. And
Mm,
so our angle is also more in the second one. It's more the institutional one where they don't want crypto volatility. They don't want to kind of bet on tokens.
yeah,
They want efficiency in the capital market space, to so that they can lend more, that they can in the end also it's a win-win for them, make more money, and that often doesn't include crypto risk in that sense. So I don't think there has been a lot of progress in crypto belief or adoption, especially after the fallout of FTX and
yeah,
obviously the bear market we're in. But I think more and more people are starting to understand blockchain use cases, USDC, and how this really will have impact. Because I think all of them really
yeah.
believe in it. And I mean, we've onboarded different funds, credit funds, multi-billion credit funds that never touched crypto before, and they are now working and using the Credix platform. They're using USDC, and they're getting into the
Nice.
details of how, crypto technology works. But they will never buy Bitcoin, or they will not buy any other crypto. So
Okay, I see. That's
it's an
so
interesting thing.
funny. Yeah, I wouldn't have
And we need to
expected that
send them
mix.
some Solana, obviously, for so that they would do the transaction. They need to accept $1 in US in
This was
Solana.
transaction. That's
Yeah.
hilarious. So you had brought something up earlier. I want to, especially when we talk about, we don't have to speculate on, is Sam lying or did he just completely incompetent? Just whoopsies, couple $1 billion gone. But like, can you walk me through like what's involved whenever people are assessing credit risk or just all the various stages that an institution actually needs to go through and the considerations they make? Kind of walk me through that because I think a lot of builders would like to know like what actually happens behind the scenes.
Yeah, the questions that you really want to know, because it's a lot of stuff. I think if you do it correctly, it's a lot of work. So we have a team, for example, here in Latin America, 10 people, boots on the ground, reaching out to fintechs, speaking with fintechs, requesting all information to be able to do a well-structured credit analysis of the debt facility we're providing them. So you have on balance and off balance sheet debt facilities to start with. You can provide credit to the fintech and have the fintech as collateral, or you can do it off balance sheet, and that means you're providing financing to the fintech or to an actually an SPV, special purpose vehicle of that fintech, and the fintech is going to put loans as collateral for the loan that you borrowed, the debt facility that you borrowed. So in that case, if the fintech would go broke, default, you still have 100% claim on the loans. So that's a narrative difference. We focus on the second one. So we work with fintechs, but we don't finance fintechs themselves. We finance loan portfolios. We buy loans of fintechs in
Yeah.
masses. So
So it's like
5
a
million,
bundle.
a bundle, 5 million worth of loans, car loans, SME loans, for example. And
Yeah.
so what we are doing is understanding how have these loans been performing in the past, auditing these loans, understanding the data insights of these loans. We are going to create institutional presentations. We're going to check, what has been the fraud, the recovery rates, and so forth and so forth. Based on that, our team is going to create a data room, and we're going to align a letter of intent to work together with a specific cost of capital, because obviously there needs to be still a cost of capital. Once we align that with the fintech, then what we're going to do, that means that fintech already passed our due diligence, which is quite rare. We have a backlog of more than 250 fintechs wanting to work
Wow.
with us, and we're very selective in who we accept in the Credix ecosystem. But the ones that enter in the Credix ecosystem, like we're going to double down on working with them on their data. We're going to put them
Yeah.
on events. We're going to put them in front of VCs. We're going to make sure that they are going to have the best damn time of their life. So it's really an ecosystem player. So we work with those fintechs. We focus on their data. We make sure that we get that data standardized. Once we have that data standardized, we're going to put that in a data room. And then we are going to present this data room to different, what we call underwriters. Underwriters are investors on our platform, specialized in credit underwriting. And they're going to check, oh, yeah, this makes sense. This does not make sense. I want to invest in this deal for this credit fintech. They can align on some additional financial covenants, concentration limits of how large the loans can be in the specific debt facility. and we are going to then do a loss audit on the underlying assets to make sure that those are indeed legit loans. Once we've
Yeah,
done all of that, then we're going to be able to register the bond. But in the end, it's going to be a bond that we register at the local, yeah,
makes sense. Yeah.
registration institution. And once that is issued, then we're going to tokenize it, and we're going to create multiple tranches out of it. The
Hmm.
junior part, that would be the first loss capital. So that means that if there would be a lot of defaults in the SPV, the first one to be affected is going to be the fintech themselves because they have to put money or loans as collateral first. If there are so many defaults that it's going to kind of eat all the collateral that the fintech has pledged, then the mezzanine investor will be impacted. So those are the credit funds that are getting higher returns, but also do due diligence, but
Hmm.
take also slightly higher risk. So those are 5 billion credit funds. Um, some are 5 billion, some are slightly smaller. You also have 250 million underwriters, for example. We just announced that we're going to underwrite $100 million with Adam Capital, for example, which
Hmm.
is a specific fund specialized in LATAM in mezzanine investing. And then once they have put their money, their USDC on chain in the mezzanine tranche, we have the senior tranche. And that's
Okay.
where the beauty of Credix comes in. What we do with the senior tranche, we're going to combine all the senior tranches to what we call our liquidity pool. And so you as a liquidity provider, you're going to invest USDC into the liquidity pool, and you're going to get back liquidity LP tokens, liquidity pool tokens. Those LP tokens, they're actually going to represent your participation into the liquidity pool. And given that the fintech from their side is borrowing the money and repaying with interest, first interest is going to go to the senior liquidity pool, then to the mezzanine underwriters, right? And as the repayments are coming in, the net asset value of your liquidity pool is going to grow. Your liquidity pool position, thus the value of your liquidity pool token will go up as well. You cannot trade on any exchange, but you can then in the future convert it for more USDC in the liquidity pool because it's going to be worth more. And so then you can cash out and receive more USDC. So that's how the system works. And so as a liquidity provider, you're diversifying your risk in a very passive way over
Yeah.
tens of deals on the platform, always with the security that there has been an underwriter, which is a credit fund that is taking higher risk than you. There has been the due diligence of Credix, and there has been a third party audit on the underlying assets.
Hmm.
And so that's how the Credix platform works.
That makes a lot of sense. There's a lot to unpack there, but there's one thing that was just burning through my mind was what percentage of that is automated using systems like bots, and what percentage of that is human cognition making decisions.
Today, it's 100% human decisions on the credit underwriting itself.
Really?
So
So
we
manually
do
going
have,
over the reports and such.
yes,
Wow.
for a large part, yes, but we also have a couple of tools to really go very deep, more in the data analytics of loan tapes. So loan tapes is just an overview of all the loans that a fintech has provided, which can be thousands and thousands of loans, and that will create automatically a report out of it. But there we need to do a manual assessment if it makes sense or not
Yeah.
makes sense and negotiate and so forth. And then the entire structure of the repayment schedule, the waterfall, so that means who's going to be repaid first, who must get which returns, what in case of late fees, early fees, usage of the funds, and so forth. That's all done through smart contracts. So all that automation that's performed on chain.
It's interesting.
Easy,
Wow.
right?
Yeah, well, what's wild to me is to think about how many moving pieces there are. I'm surprised it's still human because when I think about, I guess I'm doing a different part of TradFi, but most stock orders aren't being done by humans anymore; it's bots, and so to imagine that it's still people that was surprising. So I wonder then, with what you've seen on the, and I want to kind of dig further into this idea of like KYC kind of being a standard, and I know there's a lot of folks that looking to see decentralized maxi utopia, and I don't think that's going to really happen. I'd love to hear your take on where is that line drawn between, let's say, the previous system versus the crypto system? Do you see that it's really just all the same, or do you see something where there's a hope that like maybe decentralization would be larger? Or yeah, I'm just curious on how inevitable do you think it is that the systems will take full control?
I think more and more we will see adoption of blockchain technology. The question is it private or public blockchains or
Mm,
both? I believe both can co-live. That's also for example, I was speaking at the Central Bank of Brazil quite recently. They are working a lot on Real Digital, which is going to probably be a private blockchain. They are interested in being able to create kind of, or they are open to having stable coins backed to Real Digitals in the private blockchain, for example.
interesting.
So there is a place for both, I think, especially if you look into the cross-border space. I think a lot of
That makes
blockchain
sense. Yeah.
applications do make sense. There are a lot of
Hmm.
good applications where I think there's not the need to have KYC because of the friction it creates. I think there will just always be necessary to have gatekeepers, and I think we're going to more and more move towards that, where transparency on chain will happen more and more through to the likes of the chain analysis of the world, but
Yeah.
where brokers like the Binances and future and the Krakens and the Coinbases, they will be kind of the gatekeepers, taking care of the KYC and so forth when off ramping, when converting and coming back to the real world. And I think more and more we will be moving towards that. And I don't see it as a problem or something bad. I think it makes a lot of sense as well. Um, and I think will be the nature of where we're going towards. And I know a lot of people don't like it or think that it's too corporate, to banking,
Too corporate, that's the word.
losing
Yeah.
of freedom and so forth. But I really wouldn't watch it in that sense or see it in that sense. If you're not doing anything prohibited, there should never be a reason for you to have any challenges with it. So I take kind of the stand that it makes sense where we're moving towards, and it will actually create efficiency in our life as we all use standardized KYC sets that we can reuse,
Yeah.
decentralized identity for different applications.
I mean, I could definitely see that being useful, especially while traveling in different places. It is Serbia, for example. Currency doesn't play very nicely with most other places, and yeah, just little details you have to think of when moving around. Okay, so I wonder something. Understanding how much of the credit process is manual, with such a push towards decentralized and permissionless software, do you envision a similar type of platform like Credix being something that can be completely decentralized, or is it something where there's too much manual input required to make that happen?
On the short term, I don't see that happening. Um, the reason for that is because you still need interaction with credit is a lot about trust still.
Yeah.
So you need to build relationships with credit fintechs, with investors. You need to have backup servicers. There's a lot of legal contracts as well. Like closing deals with DAO is just from a KYC and legal perspective hard. If we're really engaging with the real world, you're going to have responsibles. You're going to have this kind of interaction still. So I think there will be a move towards more decentralized decision making, but I don't think that needs to be 100% decentralized in the sense that there is no one in control or is no one responsible better for what the technology is doing or what's happening on the platform. So I think decision making, yes,
Yeah.
governance, yes, but responsibility, I think, for the kind of institutional platforms that we're building, not on the short term.
Well, what's interesting about that is while it's something where in the short term we won't see those major changes happening, something that I do see happening is the way that we evaluate companies is changing. I mean, not just PE ratios being all over the place, but on top of that, when we take something like a crypto asset, whether it's a DeFi platform or a DApp or whatever it might be, we're wading in new territory now. And to think that there's an active lending market and all sorts of crazy financial uh, wizardry, like pieces like spells that have been created out there. Um, I guess one of the things that I wonder is just how big does it end up being? Because on some sides, I see it as okay, we take a fraction of the current financial markets. But on the other hand, people look at it like, well, it could be bigger than the entire financial markets. But at the same time, I hear both sides of it when I look at different YouTubers online. So from the way that you see institutional money moves from off chain to on chain, is it something where um, you see the crypto market adopting a smaller portion of what the market is, or do you factor in a derivatives market that makes it to where it actually balloons to be a way higher value? Like, does that make sense how I'm describing this?
Yeah, I think I get it. I think because of the size that the market can get and the access that this global technology provides, I believe the market opportunity is larger than the existing one today.
Really?
I
Wow.
think that's really where we can move towards in 15, 20 years. But that's kind of a timeline I'm also envisioning for
Okay, you're
this.
talking decades.
Um, yeah, in that sense, yes. Um, but if you look like just liquidity gap, the need for money, investment, lending in emerging markets, just that is $5 trillion.
That's
And so
specifically emerging markets.
specific emerging markets
Wow,
liquidity requirements gap. That's what's missing
that's the gap.
for lending, for
That's
lending alone.
insane. So is that where the inefficiencies come from? Why you can have 83% interest rates because there's such a gap in liquidity?
That's one of the main reasons. Yeah, because people of
Wow.
banks or investors can kind of choose who they're providing access to, right?
So it's the same
And
as like a
that's it.
low liquidity DApp, just on a national scale.
That's a good comparison. Yeah.
That's wild to me, man. So I wonder, with Solana right now, of course, we got a bit of a bruised knee from this whole SBF FTX situation. Sounds like institutions, um, they want to have safety, security, KYC, AML. They want to make sure all the T's are crossed, I's are dotted. How do you think that uh, builders in the ecosystem can be positioning themselves to be as attractive and trustworthy appearing and looking, and like what systems do you think that people can start to do to helping, like, I guess, encourage more adoption of institutions?
I think it's really building use cases that those part that one makes sense, and two those parties would find interesting or solves a real world challenge or problem, and
Yeah.
then act upon it in a very mature way. So that means understand how development of applications work. That means having dev nets, test nets, mainnet deployment, having correct audits, having the right compliance in place, having the right people in the team to do business development, have the sophisticated strategic marketing approach, and really see it as a real company rather than
Yeah.
a crazy crypto get rich fast thing. And
Yeah.
then those kind of entities will start understanding you, respecting you, and understanding that what they're investing in makes sense, is creating efficiencies, and they would be interested in adopting. And it's really, I think that's going to be the narrative for the coming years. More and more
Mm.
is focus on stuff that makes sense, and that might be in gaming, that might be in music, that can be in finance, that can be in a lot of things. But you see that more and more the teams and the applications that are flourishing in these bear markets or are really still having traction are the ones that the teams are committed, that know what they're doing, that were able to raise a decent amount of capital for, yeah, bearing this bear market, and that have a purpose and adoption that makes sense, and are
Mm.
not short-lived, as we've seen, yeah, tens of applications over the last years. And I think this sustainability, the really passionate working on your project and making sure that you're taking all precautions with regards to investment decisions and how you work with your application from a security perspective and compliance perspective, that's going to become more and more key.
There was one of those things you touched on, which was the team that you have, and what a difference that makes. I think that's one of those non-intuitive skill sets that a builder gets into, because it's one thing to be a great engineer on one's own and maybe as a small team, but then you start hiring 5, 10, 15 people. It can be, I guess, a whole nother element to be looking at. Can you kind of walk through some lessons that you've learned in building up this initiative, and maybe share some advice on how to make decisions regarding who to hire and what to look for based on where you're at, and especially keeping in mind that to raise capital in this environment, products really have to stand out with providing real world value. So yeah, well, what does that good team structure look like for a lean startup?
I think it's the most important of the entire project is a team in the end. You need to have a very good team that you can trust and that excel and that can help others in your team excel as well. And that just wake up, do the job, and help each other out to get the best out of it. And so when we hired initially, I think initially you need to find people that you can really trust. So always meet the people in person. Don't just do it over calls. Make sure to get to know them. The first hires as well. Almost two-thirds of the hires we did, we actually already knew them or knew people who actually already knew them. So a lot come down to trust,
Yeah.
um, to make sure that they have the same vision and the same passion as you have, and then really make sure that you find someone that is hungry and passionate about what you're building, and that might not even be the senior person you might be looking for, or even it just needs to be someone that has the wish and the hunger to become that person over the next months and years, and support that person in becoming that. So I think as founders, you have the responsibility as a leadership team to make sure that those persons excel in their own performance in the
Yeah.
collaboration with their team, and that they can be trained and supported in a positive way to become that person. And also make sure that you follow up a lot on culture, on um, yeah, personal development as well. That there are contact points that you bring the team twice, three, 4 times a year together, and that there are clear goals that we are as a team working towards, and break it in small pieces, so that you have the right people that know what they're doing, have the right responsibilities, have the right responsibility lines, and make the ones that make the decisions also responsible for the decision that they're making. So I think those are some of the things that we've been seeing that has been crucial to our development of a company, just on the technical side, but
Yeah.
also there's a lot on the business and legal side that needs to come together. So we work with 3 hubs where we really encourage people to come together and work together in São Paulo, Brazil, in Antwerp, Belgium, and in New York, United States, so that
Okay.
we can really feel what's going on in each other's head, and we can work together as a team on this product.
That makes a lot of sense. Excuse me. It's kind of going on that same route of decision making, and that was a lot of bombs that you dropped. I mean, just really good advice. That's going to be a really good recording. I'm excited to share that. Um, but when it comes down to other decisions, such as, let's say, token utility, for example, and I'm sorry, I should know this, but Credix, do you guys have a token, or is there any plan to launch a token?
We've deliberately not launched any token so far, and we're not even sure if we are ever going to really need it in that sense. Um, we have been doing quite some research in case we would be doing it, but it needs to make sense again. So
Exactly.
we don't want the price to plummet because we didn't align the incentives correctly, or the unit economics don't make sense, or the compliance part doesn't fit in. So it's really all needs to come together for us to really be able to use that token. I think that token comes a lot into more decentralization, governance, and so forth. And we on the in the early days we believe more in progressive decentralization that aligns well
Yeah.
with regulatory development and technological development. And I think as we grow, there is a play and a thesis to make that could be the right approach. Is something that we're still looking into, but today we don't have that token.
I wonder, how do you navigate making that decision when considering, does this, you know, token use case have real value? Like, do we really need a token or do we not need a token? Can you kind of walk through some filters that you might use to kind of, I guess, share to the collective ethos on how we can think about what makes sense and what doesn't make sense?
I think it all starts with your kind of application. Um, what are you solving, or what's the core of your product? If decentralization is key, if a DAO structure is key, if total decentralized governance is crucial from the start, yeah, then you probably can't even raise capital through VC. Then you need to work towards a decentralized way of capital raising initially to even pay the teams that are working on the product. So that's an entire different story. So it really depends on how are you building your product, what's your product, how are you building the product, and how are you going to distribute your product. A lot of use cases, especially more in the consumer base, when um, it makes sense to have them involved, have this kind of incentive, make sure that adoption is incentivized in this way, where at some point decentralized governance starts becoming more attractive, where building the application decentralized with grants for teams to propose new proposals and develop that as we grow. See, those are fantastic use cases. I think one of personally an example for me is how the guys from Ocean are doing it. I think that level of sophistication in how to manage a DAO, work with grants, work with different building
And,
teams,
and kind of
is,
catch me up.
is
What did they do that you thought was really cool?
they're really they're very professional in their approach. So they have the right forms, the right teams, the right marketing, the right governance, the right incentives to make sure that it keeps working, that the community keeps growing, and they don't just give tokens away just for the sake of it and to grow very fast. They really believe more in sustainable,
Yeah.
real world use case. So it's a big shout out to the Ocean team. I don't know them personally, but I really like their approach
Awesome
and how
shout out.
they
Yeah.
are looking into governance. So I think that's
Yeah.
I would say that's the main difference. It comes to governance, incentives, and capital raising and capital distribution once you make money. Because I think in the end, still every protocol at some point needs to kind of make money to be able to pay that out, or in dividends towards their token holders, or in token
Yeah.
price by rebuying the token. Um, I think that's what we've been seeing mostly, and there are some good examples that I mentioned. But we're starting to see more and more use cases in the credit sphere where you're using more
See.
the crypto infrastructure with some tools like USDC to get at adoption, but where you then work with other ways of more capital raising through VCs and then work with progressive decentralization.
That's interesting. I wonder when it comes down to, I guess, the types of investments, and let's just talk about the focus you guys have in Latin right now. How has your investment process changed? Whether it's how you're filtering things out now at the end of 2022 versus, let's just say, a year ago, whenever we were wondering what's going to be happening next. Yeah, I'd love to hear what kind of lessons have you guys learned this last year, and how are you positioning things for 2023?
That's a good question. I think there have been two changes, one crypto related, one non crypto related. Start with the second one. I think looking into the more macro global financial capital market space, we've seen um, with the yields going up, the risk-free rates going up, that obviously has impacted some of the default rates as well in some markets when you look into credit lending. So we make sure that our credit underwriting policy is even better structured, that we're really on top of our financial covenants in case of defaults, but also cause us to decide not to focus on consumer loans on the short term, for example, and focus more on asset-backed SME loans. So that's from a more macro perspective, a decision that we made 8, 10 months ago. Now, looking to the crypto space, what we saw was our thesis initially was that we would be able to raise more capital to crypto players, to crypto hedge funds, to crypto high net worth individuals, crypto family offices. Um, that obviously, with the downturn and the bear market, had some direct implications. So we still see some of these that are have always been playing more the long team, uh, the long game for the long time. But we've seen that some others or were affected through bear market or recent events, um, and those are in the end the ones that end up less investing in platforms like ours. And then we see more and more TradFi adoption, those kind of funds that never entered into crypto that are investing to Credix, not to invest in crypto, but to invest in credit in emerging markets. So it's an interesting,
Yeah.
different
It's
narrative that we're
fascinating
seeing
that
crypto adoption
you're the
without
use
them willing it to.
yeah, you're just a use case that's giving them a solution and it happens to be that you're leveraging crypto. I so when you're looking at how do you bring on customers, you've got 250, I think you had said, different types of products you're looking at, and of course you can only serve so many. How do you guys right now manage that type of growth? And I guess if you're kind of speaking to a builder, what are some of those things that you can suggest on how you guys nail that product market fit to create that kind of demand, and like what projects can do to be able to learn more about their own product market fit?
Ooh, that's a hard one. It really depends on your use case. I think understand your clients, speak to your clients, especially if you're a marketplace, speak to both sides of the marketplace. Um, Understand really what is the problem that you're solving. It's really the cliche, right? What problem are you solving? Is it the right technology? Is there a gain? Is there a margin to make? Does the unit economics, does that make sense? I think that's maybe an important one in the crypto space. We've seen so many
Does it
cool
make
projects
sense?
as well, but then it feels like they're doing it for free, or they yeah, they're it seems like a foundation that doesn't have any profit ideas or no business
There's no
model.
plan
Whilst
really.
that is an important that's an important part if you want to e- make it work on the long term. I think too much project in 2021 were based on VC money or ICOs, IDOs, what have you. But at some point, that money is going to dry up, and you'll need to keep the ball rolling. Um, and so, if you don't have a good monetization or dividend or treasury management solution, at some point you're going to be in trouble. So I think that's that.
That's huge because we've been talking a lot as a team, thinking about what can we do to add more value in the industry. And of course, we offer token distribution and token vesting solutions. And so we're looking at creative use cases, what can happen. And we started mapping out what services do different projects have, and what's the monetization strategy, what kind of trends can we notice. And we discovered that there was a lot of products we were scratching our heads wondering, like, we don't see any real strategy for it. And it was kind of shocking to see that this was a I can't say it was the norm, but it was shockingly common, that there wasn't much of a strategy, which I guess brings me to one of the last questions I'd come up with. Is I'd love to hear your take on SPF and FTX related. Is it from a due diligence standpoint? Someone like BlackRock, someone like these large funds that invested into FTX, what is the diligence process usually actually like with that? Because I'm still having trouble believing that nobody saw something happening when $8 billion was gone. Like, I'm not on the institutional side of things. 8 billion makes my head hurt a little bit, but yeah, can you kind of, I guess, do you understand how that can happen, or what is your take on it?
Yeah, generally we don't comment a lot on it because we don't really know what's
Yeah.
going on. So that's kind of our stand on it. I think it was in the end pure fraud. It's more my personal opinion. I think what happened there could have happened with other companies that were also fraudulent that are not in the blockchain space. Um, was their due diligence enough or not? It's difficult to say without information, but if potentially an SBF or an FTX have been showing false documents and false information,
Yeah.
that's all that you can also do due diligence
That's
on.
really where it goes from. Yeah.
After that, it becomes a a legal decision. You have a legal requirement to provide the right information. If not, you're going generally to have real legal problems with whatever that's gonna mean for you as a person.
Yeah.
So up to there, you can do your due diligence, and I expect that those larger companies have done that due diligence to that extent. Otherwise, they might just not have. They might taken a shortcut. Um, that's difficult for me to argue on. But I think what happened was more on the back side, like what happened in the back and what are the practices that really happened. And I think there is where the main mistakes have been occurring.
You're right about that blatant fraud component where, unfortunately, there's a lot of people who judge Solana as an ecosystem, um, for something that's going on with SBF, which is about as centralized as any organization can get. And it's one of those things that it's useful to look at that perspective as well. I like the way you position that. Being able to
Yeah,
consider that it's fraud. Like
I don't think.
no one can catch it. Call him a liar.
Yeah, and I really don't think Solana in any sense is to blame in any way. I think they were
I,
just by coincidence. SBF doubled down and invested, and was obviously supporting the flourishing of Solana. Um, and they have been using it for their own investments and their own what have you. But that's not a decision of a technology platform to play here.
yeah.
Um, so I really, I'm also from a technology perspective, nothing really changed with them being
Nothing.
in there or not.
If anything, it's amazing how the platform has held up through this wild, wild month.
And it's better to happen now than in the future, I guess. Um, and
Rip
being
the
less
band-aid off.
dependent from a being less dependent from a business side of FTX, I believe I believe Solana will get through this, through this downturn, through this bear market. And I think if it can get out of it, then it will be in a better position and a better shape than it was with kind of the narrative and dependency of FTX before. So yeah, we're in that sense extremely surprised as well to the technological advancements of Solana as a technology.
Now, what
It's
was it? I
really
gotta ask. That brought you to Solana.
um, we really like the way the architecture of the technology. So we've been building on Hyperledger Corda on Ethereum in the past. We really like the architecture and the programmability of Solana. We like the security aspect of it. We believe in the upgradability and progressive decentralization, as touched earlier. We like the Rust code itself. Um, we like how, yeah, a lot of updates can happen supporting the growth. We like the speed of it. We like the um, the low cost, obviously, as well of transactions. Um, so I think in general, and we were actually the first one doing real world assets lending in the
Really?
Solana system. So those were some of the main reasons why we decided to move forward with building on the Solana technology. We really like it, and we believe there's a bright future for it. And if you look into how many teams are really building on Solana, it's quite impressive to see. For example, the innovation that Metaplex is bringing to
Yeah.
NFTs and stats for NFT, it's cool. It's really cool.
Awesome. Well, hey, my friend, it has been amazing chatting with you and uh, being able to dive deeper into the institutional side of things and how, I guess, different how we can think as builders on how to position ourselves as best as possible for capital. And yeah, I guess for anybody that's watching, thank you so much for joining us here in today's show. Keep calm and build on. Till next time, y'all.